Welcome back as we study the required return on equity in detail. We'll first study return concepts, particularly the distinction between required return versus expected return. We'll then learn the various models to estimate the required return of a stock and conclude with a brief discussion on the international issues in required return estimation. Let's get rolling. The analysis of a stock's return can be based on its realized return and expected return. Realized return is based on past observed prices and cash flows, while expected return is based on forecasts of future prices and cash flows. Such expected returns can be derived from elaborate models or subjective opinions. In comparison, the required return of a stock is the minimum level of return that an investor requires in order to invest in the stock, given the company's riskiness. This return is usually based on the risk-free return plus an appropriate risk premium. Do note the differences between the definitions and that the two may not necessarily be equal. For example, let's say a stock's market price is currently $100. Analysts determine that the stock is fairly valued, so the intrinsic value of the stock is currently also $100. And based on the risk characteristics of the stock, a required return of 10% is warranted. So the intrinsic value of the stock after 1 year is $110, assuming no dividends. Based on this intrinsic value, the expected return of the stock is also 10%. When a stock price is at its intrinsic value, the required return and expected return are the same. Let's say, for some unknown reason, the stock price drops to $95 on the same day. There is no change in company fundamentals, so the current intrinsic value remains at $100. Based on its intrinsic value, the stock is now undervalued, and since the fundamentals have not changed, the risk characteristics remain the same, so the required return of the stock is still 10%. The expected intrinsic value at the end of 1 year is still $110. So in this case, the stock is expected to rise from its current market price of $95 to its intrinsic value of $110. The expected return of the stock has risen to 15.8%. In summary, the expected return of a stock is based on the forecasts of future prices and cash flows, while the required return of a stock is determined from the risk characteristics of the stock. For this lesson, we are primarily interested in estimating the required return of a particular stock. We'll go through the dividend discount approach, where we work backwards the market-implied required return based on the stock's market price and forecasted future values and cash flows. The intrinsic assumption is that the stock is fairly valued. Otherwise, we would be calculating the expected return. The second approach is the bond yield plus risk premium approach, which is simply to add on a risk premium to the company's traded bond yields. The third approach is to use risk-based models, which essentially is to determine the risk premium over the risk-free return. We'll learn the CAPM, FAMA French models, expanded CAPM, and build-up approach to determine this risk premium. We'll also make distinction between public traded stocks and stocks of private companies. Let's first study the dividend discount method. If you recall, the Gordon growth model states that the intrinsic value of a stock is its next period's dividend divided by the stock's required return minus the earnings growth rate. So essentially, we want to solve for the stock's required return based on its market price, the expected dividend, and expected earnings growth rate. This is a market-based approach, so when we use this method, we are assuming that the stock is fairly valued. Simply, if the stock price is currently $100, the expected dividend is $3, and the earnings growth is estimated at 5%. The required return of the stock is 8%. In the equity course, you will learn other forms of dividend discount models. Regardless, the principle remains the same. That is, to work out the market-implied required return based on the market price of the stock. As a reliable market price that reflects the intrinsic value of the stock is required, the dividend discount approach to estimate required return is generally applicable only to stocks that are actively traded. This should not be used for stocks of private companies. Another market-based approach to determine the required return of equity is the bond yield plus risk premium approach. This is for companies that have outstanding traded debt, such that we can estimate the cost of debt of the company based on the yield to maturity of its long-term bonds. The difficult part of this approach is to estimate an appropriate risk premium. A common approach to estimate this is to determine the historical mean difference in equity market return over a corporate bond index return. We shall illustrate this with an example. Jackie & Sons is a privately owned business with 12% fixed coupon bonds that mature in 18 years, currently trading at $97. The yield to maturity of the bond is 12.4%. An analyst decides to estimate the risk premium using the historical 10-year stock market over the 10-year corporate bond return. Using the given data, calculate the required return of the company's equity using the bond yield plus risk premium method. Pause the video now and work out your answer. And we're back. You shouldn't have much problem with this. The estimated risk premium is 3.8%. The required return on the company's equity is the yield of the long-term bonds plus the risk premium for holding equity. Be sure to use the current yield of the bond, which is 12.4%, not the coupon rate. We get a required return of 16.2%. Next, let's move on to risk-based models. Fundamentally, risk-based models estimate the required return on equity as the sum of the compensation for the time value of money and compensation for bearing risk. That is, the risk-free rate plus a risk premium. This risk premium is not the same as the risk premium under the bond yield approach, as the bond yield will incorporate the risk-free rate and the credit risk premium of the company. One simple risk-based approach that you are already familiar with is the CAPM. Under the capital asset pricing model, the risk premium of a stock is estimated using the beta of the stock times the equity risk premium, which we learned in the last lesson is the required return on equity minus the risk-free rate. You've learned in level 1 that the beta of a stock is a measure of the systematic risk of that particular stock. When it's equal to 1, we can expect the return of the stock to be the same as that of the market. A beta greater than 1 indicates that the stock is more risky than the overall stock market, so the required return is higher. And a beta less than 1 indicates that it is less risky, so required return is lower. So, for practice, let's say the current risk-free rate is 3%. The required return on the market is 7.2%, and the beta of a stock is 1.3. See if you can estimate the required return of the stock using the CAPM model. Well, you should not have much difficulty with this. Simply plug in the figures to the CAPM formula, and you get a required return of 8.46%. The CAPM is known as a single-factor model because there's just one risk premium explained by a single risk factor. The beta in this case is the factor sensitivity. The CAPM has the advantage of being very simple in that it uses only one factor. The weakness is choosing the appropriate factor. For example, if a stock trades in more than one market, which market's equity risk premium should we use? Another weakness is low explanatory power in some cases. In fact, some studies have shown that the CAPM fails to describe risk completely. For many markets, evidence suggests that multiple factors drive returns, which leads us to multi-factor models. In general, the required return of a stock is a factor more than one risk premium, each explained by its own risk factor and factor sensitivity. As such, multi-factor models can have greater explanatory power than single-factor models. However, such models also come with greater complexity and are expensive in that more time and effort has to be put in to study more risk factors. One of the best-known multi-factor models, the Fama-French model, expands upon the CAPM with two additional factors. The SMB, or small minus big factor, calculated as the average return on small cap portfolios minus the average return on large cap portfolios. This factor is to adjust for the small cap return premium, where the risk for small cap stocks is higher than the risk for large cap stocks. The other additional factor is HML, or high minus low factor, calculated as the average return on high book-to-market portfolios minus the average return on low book-to-market portfolios. This factor is to adjust for the value return premium. The book-to-market ratio is actually the inverse of the price-to-book ratio, which you're more familiar with. So a high book-to-market ratio implies that the stock has a value bias, while a low ratio implies a growth bias. According to the Fama-French model, value stocks require a higher risk premium than growth stocks. You should note that the factor sensitivity of these two factors has a baseline of 0, while the stock beta against the market return has a baseline of 1. So you can look at it this way, that the SMB and HML factors adjust the required return upwards or downwards based on the CAPM. Let's return to our earlier example, where we calculated based on CAPM, the required return of the stock is 8.46%. Using this as the baseline, make adjustments based on the two additional risk factors to calculate the required return under the Fama-French model. Firstly, we can observe that beta SMB is negative, so the stock has a large cap bias. And since beta HML is positive, the stock has a value bias. Plug in the figures into the formula, and we get 8.02% required return under the Fama-French model. In some cases, the Fama-French model is expanded to include two additional factors, profitability and investment style. RMW is the profitability premium, equal to the average difference in equity returns between companies with robust and weak profitability, and CMA is the investment premium, equal to the average difference in equity returns between companies with conservative and aggressive investment portfolios. In other words, there is a risk premium on companies that report very robust earnings, as that may not be sustainable and also a risk premium on conservative companies. Back to our example. Let's say the risk premiums on profitability and investment style are as such, and the stock has the following sensitivities. See if you can calculate the required return based on the 5-factor Fama-French model. You shouldn't have much problem with this. The required return is 7.42%. For factor models like the CAPM, the estimation of the betas, which are the sensitivity of the stock returns to a particular risk factor, is crucial. Estimation of beta for publicly traded stocks can be quite straightforward using regression analysis, as their price history is reliable and publicly available. Regression analysis was covered extensively in the quantitative methods course. Beta estimates for private or thinly traded companies are more complicated, as there is a lack of reliable price history. One approach is to estimate it based on the beta of similar public companies. This is somewhat similar to that of estimating project beta that you learned in level 1. That is to identify a similar public company and estimate its beta, unlevering the beta to arrive at a beta for a company with no debt, and then relevering it to adjust for the debt of the private company. Just know this concept, you do not have to calculate. However, this approach has limitations, as it does not consider additional risks that are often present for private companies. The expanded CAPM takes a more generic approach in the estimation of beta, that is to simply use the industry beta from peer public companies, but adds on a size premium to compensate shareholders for the risk of smaller companies, and a specific company risk premium. The company-specific premium is a general risk premium that is often determined at the discretion of the analyst. Typical factors that could warrant a premium include the competitive position, management's experience and expertise, corporate governance, financial and operating leverage of the business, and pricing power. A second approach in estimating the required return for the private company is the build-up approach. Typically, this does away with the estimation of the industry beta, but adds on a premium for the industry risk. Another way of looking at the difference is this. The baseline for the expanded CAPM is the required return for an average public firm in the industry, while the baseline for the build-up approach is the required return for an average public firm in the entire market. This is called the build-up approach, as it requires the building up of the required return on equity, beginning with the risk-free rate and then adding on the relevant risk premium to account for the various risk factors. Now, if you've studied the curriculum textbook, you will find that the industry risk premium is in the expanded CAPM rather than the build-up approach. This makes no sense, as the industry risk has already been factored in the industry beta. Nevertheless, you should follow the model given to you in the exam. The key difference between the expanded CAPM and the build-up method is that the build-up model usually assumes that beta is 1.0. And lastly, let's look at international considerations when estimating required return on equity. For companies with global operations, their overseas investments and sales, if not hedged, exposes the company to exchange rate risks. Another issue, which is more common when investing in emerging markets, is the lack of reliable data for analysis. These two issues suggest an additional premium should be incorporated in the required return of companies with global operations. This is particularly so for companies with operations in emerging markets. One way to estimate the equity risk premium of an emerging market is to take reference from the equity risk premium of a developed market and add a country risk premium to it. The equity risk premium applicable to a company with exposure to the emerging market should be calculated as such. Lambda is the level of exposure of the company to the emerging market. This is known as the country spread model. The country risk premium is often estimated using the sovereign yield spread. That is the yield on emerging market bonds denominated in the currency of the developed market minus the yield on developed market government bonds. For example, if Indian corporate dollar bonds have a yield of 7% and US Treasuries is 3%, the sovereign yield spread should be 4%, so we take that as the country risk premium. Let's say a particular US-based company has 30% exposure to the Indian market and the US market has an equity risk premium of 5.1%. The equity risk premium applicable to the company is 6.3%. The problem with such an approach is that we're using bond yields from different markets to estimate the country risk premium. Differences in legal and market environments among countries have different effects on bond yields, so using bond yield spread alone may not accurately reflect the country risk. To address this issue, an adjustment to the sovereign yield spread by the ratio of standard deviation of the emerging markets equity and bond markets was proposed by Damodaran. So, for example, if the Indian stock market's volatility is 15% and the bond market's volatility is 12%, the country risk premium should be 5%. The applicable ERP for the US company should be adjusted to 6.6%. Another approach to estimate the required return for companies with global operations is to use the extended CAPM. Do note that this is not the same as the expanded CAPM we just learnt earlier. Instead of estimating the ERP based on a single market return like the S&P 500, the global CAPM approach uses a global market index such as the MSCI All Country World Index to estimate the ERP. The beta in this case captures the company's relationship with the local economy relative to the global economy. Lower values of the beta indicate lower integration of the company with a global economy. The international CAPM adds one more factor based on a foreign currency index, which aggregates the return from investing in the foreign currency relative to the company's domestic currency using country relative wealth. That's quite a handful, but you just need to know that it estimates the exchange rate risk. The beta captures the sensitivity of the company's cash flows to changes in its local exchange rate. The limitation for both the GCAPM and ICAPM is that the beta G can be very low or even negative due to the low correlation between developed markets and emerging markets. For this reason, the use of these models is usually limited to companies with global operations that are limited to developed market. For companies with exposure to emerging market, the country spread model from historical should be used. However, this is on the assumption that the historical estimate is representative of the risk premium going forward. And that concludes this rather long lesson on the required return on equity and this topic on the cost of capital. Take a break, and we'll see you at the next topic.